So a lot of back and forth this week, particularly with the FOMC statement that came out on Wednesday that sent the stock market rocketing higher to the tune of 100 points off of the day's lows. But then you had 2 more days to the downside where the S&P 500 still cannot break through that 4,700. So are we going to get the stock market crash going into the year end? Or is the stock market going to give us the infamous Santa rally? First off, it's worth noting that historically, the Santa rally is the last 3 days of the trading year and the first 2 days of the new year. It's not just the whole month of December or the week of Christmas. That's what a lot of people have mistaken. It's usually the last 3 days of the trading year and the first 2 days of the new trading year. So keep that in mind. Meanwhile, we're going into a shortened week with the stock market close on Christmas Eve. That only gives us 4 days of trading, which means you're going to see a lot of light volume in the week ahead. That means a lot of traders are going to be going out on vacation already. Wall Street will be going off to the Hamptons, I suppose. And there's a good chance you'll see a little bit of a tamer price movement unless there is some major headline risk that hits like what we saw back on Thanksgiving week, and in particular the day after Thanksgiving. But overall on the week, the S&P 500 finished down 2% on the week. The Nasdaq 100 finished down 3.3%. The Nasdaq Composite finished down 3%, and the Russell 2000 finished down 2.2%. So that means there was a little bit more safety in the small caps than what you saw in big tech stocks, which has not been the case for most of this year. You're also seeing the S&P 500, the Nasdaq, and the Nasdaq Composite finishing lower for the 3rd time in the last 4 weeks, and the Russell 2000 finishing down for the 5th time in the last 6 weeks. So there's a lot of bearishness that's been kicking in with this market. So what I want to do with this video, I want to go through the indices. I want to show you what we're looking at, the support levels that we're sitting on, and the potential for either a Santa Claus rally or a stock market crash in each, or maybe it's just going to be a flatter tone like a lot of times you see during the holiday weeks. First off, make sure you smash that like button and hit the subscribe button so you can get all of my notifications on future videos. Also, make sure to click the join button so you can become part of the YouTube membership. Get all my market research each and every day. That's going to include regular updates on the S&P 500, Nasdaq 100, and Russell 2000. You're also going to get my most intriguing charts of the day, plus my weekly master watch list, plus the daily stocks that I'm looking at each day. You're also going to get updates on all the FANG stocks. So make sure to click that down below by hitting the join button. First off, we're going to get into the SPY ETF, symbol SPY. Again, 4,700. This is the same on the S&P 500. This 470 on SPY, 4,700 on the S&P 500. Very difficult for the price to break through. In fact, when you saw the FOMC reaction, when we rallied about 100 points off the lows, it looked very much possible that we were going to see a break finally through that 470 level and a bigger expansion beyond the current all-time highs. However, even with the gap up on Thursday, the market gave it all back. And that was a big turning point for this market because now we have seen 2 strong days of selling. We got the S&P 500, 111 points off of its Thursday high. So some significant movement here in place. But even with the selling that we saw on Friday, the one thing that held up, and this should be the cause for concern for anybody that's a bear in the market, is that we're not breaking below the 50-day moving average. We're not really correcting. We're just pulling back to this 50-day moving average. It's not a perfect moving average. We're not necessarily holding it up each time, but we will break down a little bit below it and then reclaim it the next day, or sometimes we just bounce exactly off of it and ride back to all-time highs. Nonetheless, it's holding once again here. So the last time we tested it for about 4 days, and then it rallied back up to the all-time highs. Now we're testing it again here. It's a little bit of a higher price this time, but we're testing it nonetheless. So the question becomes, can we hold this 50-day moving average yet again and re-challenge those Thursday highs, if not all-time highs that were established back in November of this year? Also keep in mind on the increasing volume that we are seeing on the S&P 500 and SPY. Solid volume that has been steadily increasing over the last 7 trading sessions. If the market breaks this 50-day moving average, where do I expect it to go? I think we're going to see a retest of this rising channel. That's what makes the most sense to me at this point. The other possibility is for there to be a retest of support that goes back to the all-time highs that were established in early September. You could easily see this retest that may also converge with this rising trend line, offering a great deal of support. If that gets tested, look to see how price reacts. Does it break right through it and then rally back intraday to hold it into the close? If so, that's a good sign that the markets will try to bounce off that level. If it continues to break through it and then follows through the next day, that likely means that we're going to see much further downside, maybe even test the lows from this past October. Now, let's check out the Qs. Remember its head and shoulders pattern that was formed in early November. You have the head here in mid-November, and then you have the right shoulder that was formed here, confirmed, broke down below, rallied back, looked like it was going to go ahead and nullify this head and shoulders pattern. But what it might have actually done is create more of a bigger head and shoulders pattern in the process, where we thought that this might have been the right shoulder before. Might actually be the case that this is the left shoulder head, and then this rally back up, form the right shoulder. So now what becomes of huge importance is, do we break below these lows that were established in December? There's not a real clean neckline that you can draw here for this head and shoulders pattern. Instead, we need to just say, okay, if it breaks below the December lows, things are going to get much more bearish, especially if it can't hold this rising trend line that goes back to June of last year. This is going to be a huge critical moment here. If this head and shoulders pattern picks up a lot of steam to the downside, it may be difficult for the market to hold this trend line. However, if you see it, just like with the S&P 500's rising trend line, if you see where it tests it and it can hold it into the close, or breaks below it and rallies back above the trend line going into the close, very good chance that that could be a short-term bottom for the market. Also worth pointing out, you got a lot of volume that's been pouring in here, particularly on the down days. That's usually needed for any kind of sustained sell-off. You can't really sell off too much these days on low volume. You need strong volume. That oftentimes will come with headlines that create panic among traders. You're also seeing too with Apple down 4.7% this past week. Why did the tech not go down as much? Tech was actually a little bit more resilient than Apple was. The tech sector overall is what I'm really talking about here, not just the FANG stocks, but all of your tech stocks. They were only down 3.2% to Apple's 4.7%. So we're seeing more selling in the Apple side and the big tech stocks than what we're seeing in the overall market, even with small caps, which was only down 2.2% this week. So what that tells me is that we're not really going to cash in this market. Investors aren't showing signs of wanting to go to the sidelines just yet. Instead, what they're doing is they're rotating money back and forth. They're going from Apple and the big tech stocks back into small caps, thinking, okay, maybe they're going to rally now and tech stocks are going to sell off. Nobody's really wanting to play it conservative right now, and that's making it very difficult for the market to see any kind of real strong downside going forward. When you start seeing big, broad-based sell-offs beyond what we've seen this week, I'm talking about where you're seeing 3 and 4% sell-offs across the board in all the indices, then you know investors are starting to panic. But right now, ask yourself, what are we seeing here? Yes, the market's down 3 out of the last 4 weeks, but what are we really seeing here that looks like a bear market? Nothing so far. It's just very choppy. It's churning people out of a lot of their capital. Now, yes, I think conditions are growing more bearish, but people are talking about that we're already in the middle of a stock crash. No, we're not. Does Apple look like it's crashing to you? Does Google look like it's crashing to you? No, they don't. Google's more sideways than anything. Microsoft, no. Facebook, maybe. It's in a downward channel, but it's not that far removed from its all-time highs either, especially when you consider how far it's come over the past year and a half. What about Tesla? It's 25% off the all-time highs, but it's also been one of the more volatile stocks to the upside over the last 3 or 4 months. So when you see a 25% correction, just like when you see one in Lucid, or when you see something in like DWAC, I'm not trying to say that they're the same stock, obviously, but big rips to the upside are going to have big pullbacks to the downside. Now let's look at the Russell Index here. Russell 2000, all the way back to January of this year. Huge, huge support level. It just can't seem to break it. Again in March, and then again later in March. You've got it again in July and August, and then in December, multiple times. It's not breaking it. You have a declining trend line here that all traders should be worried about. Even if we do keep this bounce going, can it break through this declining resistance that continues to get closer and closer to where the current price is right now? In the past, it has consistently rejected price. If it rejects it again, is that going to be enough to finally send it below this major support level? Something has to give. Wouldn't surprise me if we saw something finally give this week, whether it's to the upside or to the downside in Russell, but both of these levels cannot sustain forever. A lot of volumes pouring in. You're seeing a high level of volume on Friday to the upside. That tells you right there that a lot of your investors are moving from the tech stocks and they're going right back into small caps. They're not going to cash. They're rotating their money somewhere else. I do think that that's going to ultimately burn a lot of investors, because when the market does have a sustained pullback, they're going to be jumping back and forth between different sectors, different industries, different segments of the stock market, and they're not going to find anything to really sink their teeth in to preserve their capital, and they're just going to continue to lose it in just a myriad of different ways. But for now, on the weekly chart of Russell 2000, this support level is holding very, very well. down 5 out of the 6 weeks, but it's bending, not breaking. Maybe that changes next week, but for right now, we got to work with the information that we have in front of us. It has not shown that it can actually break and sustain a move below this massive support level. We're also seeing a lot of people putting their money into some of the safer stocks. Let's take a look at the daily of NextEra Energy. This is a utility company. A lot of people like putting their money in utility plays when things start to get uncertain. Again, NextEra Energy, yes, it finished down on Friday, but overall it continues to push higher. It was up on the week. It's up 3 weeks in the row and 10 out of the last 11. That is massive, especially in this environment where the S&P 500 has been down 4 out of the last 6 weeks. This stock has been up 10 out of the last 11. But don't stop there. Look at Costco. Continues to rip higher on the weekly chart. This is another safe play. This is one of your staples. It's a discount store. You got Dollar Tree. Same exact thing. In fact, it's bull flagging here at its all-time highs. So you're seeing rotation in the small caps. You're seeing rotation or continued rotation into more of the safer industries like your staples, your utilities, your real estate stocks. And they're starting to get weary of holding on to Apple. At least we saw that this week. Maybe it bounces back the coming week. Not sure yet. We'll have to just wait and see. I'm not trying to instill fear in you as traders. I'm wanting you to plan your trades and to watch the market for the risks and the rewards that are currently present in it. Being naive and thinking that the stock market's going to go forever, or even worse, think it's going to go to the moon or colonize Mars, is what's going to get a lot of traders inevitably in trouble, because they're going to continue to buy the dip all the way down. When you get a correction, there's no dip buying that's going to work. It's going to continue to massacre you until it finally does put a bottom in. And those bottoms can often be a lot further down than what you expect. So be careful. I'm not saying that you need to sell everything. I've obviously outlined a lot of areas on the charts that are important. You have the 50-day moving average on the Qs. You have major support on the Russell 2000 that's still hanging on. You have the 50-day moving average on the S&P 500 that is still holding on. So there's a lot to be hopeful for from a bullish standpoint. Seasonally speaking, we're going into a very bullish part of the year. Does that mean it's always going to rally? No. Go back to 2018. You'll see how bad it got in December of 2018. It was really bad. And that happened when the Fed started talking about tapering and raising interest rates. So we're not out of the woods, guys. There's some goods, there's some bads, there's some pros, there's some cons. Trade accordingly, follow the charts, trade what you see, not what you think or what you need to have happen, but what the market's willing to give you. If you enjoyed this video, go down to the comments below. Let me know what you think. Tell me, what is your plans for Christmas? Not just with the stock market. Tell me some of your plans for getting away and taking a break from all the madness that we've experienced this past year. I want to hear all about it. Thank you guys, and God bless.